Imagine a company that seemed untouchable, a corporate giant celebrated as one of the most innovative in America, hailed as a symbol of energy, power, and wealth. Now imagine that same company, just a few years later, collapsing into bankruptcy, leaving thousands jobless, wiping out billions in investments, and shaking the very foundations of Wall Street. This was Enron, and behind its gleaming facade was a secret so shocking, so audacious, that it became the blueprint for modern corporate greed. Today, we're going to uncover the ghost of Enron, a tale of lies, deception, and a cautionary lesson for the entire financial world. But the real question is, how did the smartest minds in corporate America fall for the biggest accounting fraud in history? And why does its shadow still haunt the financial world today? To understand Enron, we need to start in the early 1980s. The company was formed in 1985 through a merger between Houston Natural Gas and Internorth, creating a new energy powerhouse. Led by visionary executives like Kenneth Lay, Enron promised to revolutionize energy trading, moving beyond pipelines and electricity into the emerging world of energy markets. What made Enron different wasn't just its size, it was its culture. Wall Street analysts called it a company of innovators pushing boundaries, embracing risk, and valuing ambition above all else. Enter Jeffrey Skilling, a prodigy from Harvard, obsessed with the idea of turning Enron into a trading behemoth. Skilling introduced mark-to-market accounting, a practice that allowed Enron to book potential future profits as current revenue. On paper, it made the company look incredibly profitable. In reality, it was the first step toward disaster. Enron's rise was meteoric. Its stock price soared. Employees cashed in stock options. Executives earned millions, and the public bought into the story of a company that was supposedly smarter, faster, and more innovative than any other in America. But beneath the surface, the numbers didn't add up, and that's where the story gets chilling. Throughout the 1990s, Enron positioned itself as the king of energy trading. It wasn't just about pipelines or electricity, it was about creating complex financial instruments, derivatives, and off-balance sheet partnerships that allowed the company to appear profitable even when it wasn't. Skilling's philosophy was simple: growth at any cost. Profits didn't matter, perception did. The more Enron could convince investors and analysts of its success, the more its stock price would climb, giving executives massive personal gains. And the system encouraged deception. Enron created hundreds of special-purpose entities, shell companies designed to hide debt and inflate profits. Names like LJM2 and Chuco became infamous for masking the truth. Yet, almost no one outside Enron saw what was happening. Wall Street analysts praised the company, auditors turned a blind eye, and journalists were dazzled by its innovation. It was the perfect storm: a culture of ambition, a public hungry for success stories, and a financial system ill-equipped to detect fraud. But behind the glamour, cracks were forming, and it all started with a simple question: how much of Enron's growth was real, and how much was smoke and mirrors? The first warning signs appeared in 2000. Analysts noticed irregularities in Enron's financial statements. Profits seemed too consistent, too perfect. Some employees raised concerns internally, but they were ignored or worse, silenced. Then came the most shocking revelation. In late 2001, Enron admitted it had overstated earnings by hundreds of millions of dollars. The stock, once climbing toward $90, plummeted to single digits. Investors lost everything. Employees who had invested their retirement in Enron stock were financially ruined. Executives scrambled. Kenneth Lay, Jeffrey Skilling, and CFO Andrew Fastow faced mounting pressure. The public was outraged, and regulators began to dig deeper. What they uncovered was a tangled web of accounting tricks, off-balance sheet partnerships, and deliberate deception designed to enrich executives at the expense of everyone else. By December 2001, Enron filed for bankruptcy, the largest in U.S. history at that time. The fallout was massive. Arthur Andersen, the company's auditor, was implicated and ultimately dissolved, erasing one of the big five accounting firms. Enron's collapse shook Wall Street, the energy markets, and the confidence of millions of Americans. The aftermath of Enron was chaotic. Thousands of employees lost their jobs and savings. Investors lost billions. Executives faced criminal charges, and the public demanded accountability. Congress acted, passing the Sarbanes-Oxley Act in 2002. designed to tighten corporate governance and prevent another Enron-style disaster. Companies were now required to implement stricter internal controls. Executives had to certify financial statements, and auditors faced tougher scrutiny. Yet, despite these reforms, many experts warned that the culture that allowed Enron to flourish hasn't entirely disappeared. Today, corporate scandals continue, though often in more sophisticated forms. Accounting tricks, off-balance sheet liabilities, and inflated valuations still plague the market, proving that the lessons of Enron are as relevant now as they were 2 decades ago. Fast forward to today. The financial world has changed, but the patterns remain eerily similar. Consider the tech startups and corporate giants whose valuations defy reality, or companies using complex financial instruments to hide risk. In many cases, investors are dazzled by growth and innovation, just like Enron's investors in the 1990s. Data shows that corporate debt in the US has reached record highs. Derivatives markets have exploded in size, dwarfing the global GDP, and yet, regulatory oversight often struggles to keep up. The ghost of Enron lingers, reminding us that unchecked ambition, opaque accounting, and a culture of profit over ethics can create disaster at any time. The lesson is clear: the structures may evolve, but human greed and the systems that enable it remain consistent. So what can we learn from Enron's ghost? 3 key takeaways. 1. Transparency is non-negotiable. If a company's financials are too complex or opaque to understand, that's a red flag. 2. Culture drives behavior. A corporate culture that rewards risk and hides accountability will inevitably lead to disaster. 3. Regulation alone isn't enough. Laws like Sarbanes-Oxley help, but vigilance from investors, employees, and auditors is critical. Enron wasn't just a story of bad accounting, it was a cautionary tale of unchecked ambition, systemic failure, and human greed. The ghost of Enron still haunts corporate America. It's a reminder that innovation without ethics can become destruction, and that the pursuit of profit can blind even the smartest minds. So, the next time you hear about a company promising astronomical growth, remember Enron asked the hard questions. Because history has a way of repeating itself. If you found this story revealing, hit that like button, subscribe for more deep dives into corporate scandals and financial mysteries, and comment below which modern company do you think could be the next Enron.